What's up, investors? This is another company review analysis. It's the weekend, so I do these. During the weekday, I do account reviews and update you on my account performance. But on the weekends or when I have some free time, I like to do company reviews. Now, this is not a DCF, discounted cash flow analysis, okay? This is something much more scientific, something that's going to give you much more depth on the subject. And you're not going to be left out here with just looking at some numbers and have to figure everything out on your own. No, this is different. This is much more informative. We're going to do the kitty account analysis, company analysis. Today we're going to be looking at HRB, which is the H&R Block company. It's a publicly traded company. Many of you probably use it to do your taxes. Also, I realized that it's been about 30-40 seconds into the video and there's been no edits yet. And I'm sorry to say, but you're going to have to get used to that because I care about your social skills. I want you to have the patience and sit through the stumbles and the missteps that I may do throughout the entire video. It's kind of like communicating with an actual person, which is, not so common nowadays. But either way, let's go into the analysis. I'm going to use the stockanalysis.com website to determine what's going on with this company. And I'm going to rate it based on 9 criteria or so. Let's see if these are 9. I think 11 actually. I can count. I'm really good at counting. It's one of my strengths. So first, what I like to do is a little overview of the company. Like I mentioned, everybody knows H&R Block. They help you do taxes, especially retail and workers, any kind of worker, basically. Sometimes even small businesses and stuff like that. And they charge an arm and a leg, by the way. I've stopped using them and I use TurboTax now. I do my own taxes. Sometimes I have someone else help me, but I will never use H&R Block because they charge me like, I don't know, $3 million. No, they charge me like $1,000 or something like that. It's ridiculous. It's a lot of money for somebody to help you with some numbers. This is the first window I like to look at, which is the revenue and earnings at a glance. One thing we can notice is that the company makes money. Not only does it revenue money, but it actually has actual earnings. So the green part is earnings. But it looks kind of steady, so we'll see how boring that is as we go through the numbers. Next thing I like to do is what the stock's been doing when it comes to price action. So this is as far as this graph will go, all the way back to 2007. One thing that interests me about this graph is that in 2008, it actually didn't crash that much. It went from 25 to 15. Which might have seemed a lot at the time, but if you just look at it from a larger perspective, it's just noise. You can't even find a great financial crisis for this company, which tells me that it's pretty resilient. It can withstand quite a bit. This is the March crash of 2020. And yes, it declined by 50% or so, but then it just bounced back. So from a longer term perspective, it doesn't look all that scary, does it? So next, we're going to dive into the financials and find out our first criteria and figure out where to place it. Revenue trend. In order to find that out, we're going to financials. Now, I'm not going to go on the quarterly. Usually, I like to click this quarterly tab in order to find out more detail, get a higher definition as to what's going on in the company. But when I do that, because this company is so cyclical, this is what I get. It doesn't tell me much from a visual perspective. So we're going to stick to the annual. Okay, so here we go. Annual revenue. This looks much more organized, to be frank. And it looks like the revenue is growing at a very, very slow pace. It used to be a little bit under 3 billion back in 2012, and now it's a little bit over 3 billion. And quite, to be honest, that's kind of just keeping up with inflation. So from a revenue trend perspective, it couldn't get any more boring. Just can't. So we're going to do a 1. Okay, on the board kitty segment. Next is earnings trend. To find out the earnings trend, we need to go under net income. So it looks like outside of the anomalous, 2019 year here where they lost a little bit of money. Let's write that one off. It's been pretty steady. I mean, more or less than half a billion worth of earnings per year. It's really, really steady, which is good, but also not fantastic. I mean, you're not gonna get anybody excited about investing in H&R Block because they have the steadiest, income ever. There's no growth. So for that, we're gonna give it a board kitty again. So revenue trend, earnings trend, two board kitties. This is looking real boring so far, isn't it? All right, dividend and payout ratio. Okay, so there's actual dividend tab here. We can see that the dividend yield is 2.64%, which is, on par more or less with the S&P 500, which is fine. Payout ratio looks extremely healthy at 33%, so that's great. Dividend growth, oh, look at this. Finally, we get some excitement. 4.67% growth dividend increase per year, which is probably higher than inflation altogether on average. Let's see the trend here. It looks like they have definitely been increasing the dividends over the years. You can see the dividend chart here better. So you can see how they increase about maybe once every 2 years or so on average, which is nice. I like it. So that's a good number, 4.67, great healthy payout ratio, solid dividend. I'm actually going to have to give them the approval cats here with the 2 thumbs up. You see the kitties are, happy about that rating. So dividend and payout ratio, great. Next, share buyback trend. All right, let's see if we can find something else in the share buybacks. So let's look at the outstanding shares, and we can see that they've actually been decreasing over the years. In 2014, there were almost 300 million shares, right? 280 or so, I'm guessing. And now there are 159. So almost half the shares outstanding that existed in 2014. So H&R Block has really been returning a lot of this capital back to investors in the form of dividends and share buybacks. So this is an investor's stock. I mean, you want this if you want to be able to pay your bills. Like, this is not bad. In other ways, another way to look at it is if you bought this company in 2014, let's say you bought 100 shares, or not 100 shares, let's say you bought 1% of the company, okay, which is a lot of money, I realize. But let's pretend that you bought 1% of the company. Because of their share buybacks, if you just held your shares and did nothing, you now own 2% of the company. So that's not bad. I like that. Moving on. Dividend and payout ratio, share buyback trend. That's actually an approval cat. Approval kitties here. I think this is really good return to investors type of environment. All right, price to earn. I'm sorry, cash on hand is next. How much cash do they have? Now this is what gets me a little bit worried. You can find out at a quick glance how much cash they have by comparing the enterprise value to their market capitalization. You'll see they have like maybe $1.5 billion of debt. We can scroll down to the shortened balance sheet over here and look under net cash, which is going to give us their cash position, which is almost exactly minus 1.5 billion. Now, normally for a public company, that wouldn't be that big a deal, except this company is worth 6.8 billion. So that's quite a big a percentage of their overall market capitalization, right? So I don't like this debt. Personally, let's figure out. Let's go back to the financials. Go to the balance sheet, and let's see how this debt has changed over the years. Okay, so we're gonna go to total debt, and we can see that it's been growing a little bit steadier here, a little steady. So I'm not a big fan of that. So they've been using some of this debt to probably finance share buybacks, and that means that going forward, these share buybacks are probably going to decrease or cease altogether. So even though they've been doing good until now, they're probably going to have to stop. If they continue, they might load themselves up with debt, with high interest debt. They're going to have trouble paying, and it's going to dig the company a little bit further into trouble where it won't it won't be a good investment anymore. So this is something to watch. I mean, very carefully. So I'm gonna say cash on hand is actually a sourpuss a little bit, because this debt is gonna be a little bit of an issue going forward, I think, and the way they've been operating this far. So there needs to be a change. It doesn't have to be a problem, under really low rates. It isn't, but moving forward, I think it will become an ever increasing issue. So we're gonna give it a sourpuss. Next is the price to earnings ratio. We're gonna go under statistics. Price to earnings is right over here. PE ratio is about 14. For a company like this with no growing revenue and no growing earnings, this is kind of fair to high. This is on the high side, in my opinion. So it's not really very attractive. It's not extremely overpriced either. So we're gonna give it a board kitty. Enterprise value over earnings. So EV over earnings. Here it is, 15.41. Again, it's a little bit on the high side, but not outrageous. Another board kitty. We're zooming through this pretty quick. Next, enterprise value over free cash flow. This is a metric I really like. This actually doesn't look too bad. 11.22 is pretty fair. It's pretty low. I like it. It's not bad. Okay, 3 approval cats for that one. Next, we're going to be looking at profit margins. To find that out, we're going to have to go back to the financials and see how the profit margin has been progressing over the years. It seems like it's sticking around 16%, which is the current profit margin, and that's, not horrible. At least they're consistent. It's not decreasing, but it's not increasing either. So I'm gonna have to give them another board kitty for that. So a lot of boring stuff. We were on a roll for a second, but now it's getting a little more boring again. Profit margin trend, we just discussed that. We're gonna give it another board kitty. And the story. Okay, so to find the story, we're gonna have to think about the company. So what is this company? It's a company that helps people do its taxes. I mean, come on. It couldn't get any more boring than that, right? It's just every year you have taxes from the government. These guys help you do it. There is no story there. That's it. It's just a service. You have a bunch of tax professionals helping you out. I've had experience, like I said, with H&R Block, and it's been fairly negative. Even when I ask questions to the tax professionals, they either don't know or they refuse to help me because it's extra work for them that they're not getting paid for. So I don't like that company personally, but some people rely on it, to make sure that their books are right. It's not easy doing taxes, that's for sure, especially if you have a complicated operation going. And so there's basically no story outside of that. I mean, it's just things nobody wants to do that they have to do, and that's it. So the story, I mean, there's zero chance for growth there unless they make the tax code something super complicated where it forces people like me to go to H&R Block that can't figure things out on their own. That's the only thing that would actually, have them boost. But I don't see that happening, or at least if it does happen, it's going to happen slowly and not quickly all of a sudden. Things are going to dramatically change. I don't see that happening. So there's no story there. No story. So I'm going to give that a super big board kitty number 7 here. Okay. Well, let's take a look here. We got 3 approval cats, 7 board kitties, and 1 sourpuss. Overall, this company, I would say, especially at this price, I mean, it was half the price just a year earlier. So if you were going to buy this company, you probably should have bought then. Now it's much more fairly valued. If you're going to buy this company now here at these valuations, which are $42.38 at a market cap of 6.8 billion. If you're going to buy these valuations after this run up that we've experienced since January 2022, you may have missed the boat a little bit. If you buy here, don't expect much. It's just basically for capital preservation slash very, very mild dividend that helps you keep your portfolio afloat. I actually can't see a function outside of wealth preservation that this company can serve in your portfolio. I just can't see it. So there you go. That's the reality. Let me know if one of the kitties is off. If you disagree with one of my ratings, excuse me, which one and why. I'm eager to hear from you about what I did wrong here with my analysis. If you have a better idea, maybe a competitor on their industry that's up and coming or something, another company that serves the same function a little bit better, please let me know in the comments below. And I'm looking forward to arguing with you over these figures here. All right, that's about it with H&R Block. Hopefully you got a little bit perspective off of this to help you with your analysis and decision whether or not to buy this company and make it part of your arsenal there, part of your army when it comes to generating some cash. All right, that's it for now. Oh, by the way, like I mentioned, I do videos that update my own account during the week, so make sure you catch those or look for my other company reviews in the future. Peace out.